Valuation. Valuation means the quantitative representation of values of business or entity. An entity is represented or valued not only by its tangible assets and liabilities found in the balance sheet, but also by its intangible assets like human resources, trademarks, copyrights, brand name, present customers, prospective customers, scientific or technical knowledge, design and implementation of new processes or systems, licenses, intellectual property, etc. For example, in some companies, we would have seen the importance of its chief financial officer or managing director, etc. The whole functioning of those companies may sometimes be depending on the few persons present in the helm of affairs or board of directors. So, the well-talented or well-knowledgeable human resources of the entity definitely add to the value of the company. Similarly, we would have observed the behavior of buying the same brand many times by the consumers. It is the function of brand value. The intangible assets are more helpful to sell the products in the desired way, to lead the company in the right direction, to differentiate the entity from its competitors. So, whenever we are telling business valuation, it is inclusive of its tangible and intangible assets. The decision on what to value, how to value, when to value is depending on the purpose for which it is being valued, the user to whom it is being valued. Now, we shall see some purposes and what is being valued for them. When a business entity is planning to purchase an entire business of other entity, it has to consider the valuation of tangible and intangible asset of the other entity. It would study the future expected earnings of the other entity. Based on these valuation and study, the purchase value of the business will be decided. Whenever we are purchasing a running entity, we are having the advantage of entering into an existing business with good knowledge of its risk and return. This advantage is not coming freely. So, it is also valued while purchasing the business in the form of goodwill. The present values of the future earnings of the entity will play an important role while deciding the goodwill value of the business. Similarly, when there is a merger between two entities, the shareholders will be interested to know their share in the wealth of the merged company, and it will be decided based on the intrinsic value of the company. Intrinsic value is what an asset or business is actually worth rather than its market value. This value may differ from the current market value. In the case of liquidation of a company, the realizable value of the assets of the company is important to distribute among the members and creditors of the company. Here, the realizable value of all the assets after meeting its liabilities are to be known. While investing in the business of other companies, we shall be interested in the present value of the future earnings of the other company. This again will be decided based on the investor's expectations, requirements, the satisfaction of ownership of the particular asset. For example, owning certain company shares may make the investor to feel safe and secured as to their capital and earnings from those shares. As per the Wealth Tax Act, to know the correct amount of wealth tax amount, we have to value the particular assets in the particular manner as defined in the Income Tax Act. When a banking or finance institution is providing loan to the business of a company, it will measure the securities given by the company in realizable monetary terms. to utilize the realizable value if there is any default on the part of the company. Further, they would study the risk of the particular business in which the company is involved. They would analyze important ratios, other debt obligations, and the position of the company in the market when compared to other companies. As per Section 211 of the Companies Act, the auditor of the company should ensure whether the financial statement of the company give a true and fair view of its affairs. In this scenario, the auditor has to check the valuation method adopted and the accounting policies followed while valuing the assets of the company. If need be, he may seek the help of competent valuer to value the assets of the company. Now, we shall see what are the bases of valuation and how it is adapted to value the assets. The basis on which the valuation is being made differ from the purpose to purpose, asset to asset, time to time. Historical cost. In the historical cost, the assets are recorded in the books in the value in which it was purchased or the fair value adopted at the time of acquisition. Most of the fixed assets are valued on historical cost basis. Current asset. In this basis, the assets are recorded or valued on the replacement value of the asset in the current period. Realizable value. In the realizable value basis, the net disposable value of the assets is considered to value the assets. Present value. Here, we are finding the net present value of the cash inflows and outflows by utilizing suitable discount percentage to adjust the time value of the money and the risk factor in the industry. This present value basis will be useful for project's evaluation purposes. Liquidation value. Liquidation value is the net realizable value after disposing all the assets. As the business is getting closed, the realizable value in the event of liquidation will be less than the realizable value which we can get in the normal period of sale. In liquidation basis, there is a compulsion to sell the assets immediately and distribute the dividend. So, the worth of the business will be more dead than alive. Fair value. We would have seen its application in the capital gain problems in income tax. This fair value will be based on the time and situation. The definition of fair market value is the amount at which property would change hands between a willing seller and a willing buyer when neither is acting under compulsion and when both have a reasonable knowledge of the relevant facts. So, the main points in the fair market value are there are willing buyer and seller, no compulsion for both the parties, and both are having reasonable knowledge of the relevant facts. Situation or type of values. When the company is doing well and expected to do well in the future too, the valuation of its business will be high. This is called the concept of going concern value. When there is an expectation of dissolution of the business, the value of the business will come down drastically. This is called liquidation value. Book value. Book value is nothing but historical cost. After additions, deletions, and depreciation, the asset value will be shown in the books of accounts. If somebody is ready to purchase the asset, the amount which he is willing to give is called market value. Fair market value and intrinsic value we have already seen. Exit value is the value expected for the business or shares when we plan to come out of the business or sell the shares when the business or shares are in the boom period, thinking that such a boom period will never occur in the near future. This value is based on the expected future earnings from the business. Different approaches of valuation. There are three types of approaches to value: income approach, market approach, and asset based approach. In the income approach, the theoretical approach of net discounted estimated cash flows of the project or business are found, considering the potential risk of the business. Market approach. In the market approach, most of the time, the valuation is being done based on the price earning ratios. Selection of similar companies and similar transactions are made and it is compared while valuing. Asset based approach. This approach is having limited applicability for ongoing business entities. This method is useful when the valuation is done in the event of liquidation or closure of business. The fair market value is found and restated here. This method is also useful for valuing holding company securities when its assets are easy to value.